So, let's dig into the pantry and see what's really cooking over at the Campbell's company. It's been a pretty wild year for them, and we're going to break down their latest financial results. The big question is this food giant simmering towards a comeback, or are some of its famous brands getting left on the back burner?
You know, at the heart of this whole story, you've really got two main characters. On one side, you have that classic, iconic red and white can of Campbell's soup. I mean, it's been in American cupboards for over 100 years. And then, on the other side, you have its new, shiny, premium, secret weapon, Rao's homemade sauce.
So one of these represents this deep-rooted heritage, comfort food. The other, it's a big bet on high-end products and what modern shoppers want. And how Campbell's juggles these two worlds, well, that's the key to understanding everything, their performance right now and their whole plan for the future.
All right, let's get right to it. The scorecard. How did Campbell's actually do this past year? The top-line numbers are going to give us our first major clue.
So if you listen to the CEO, Mick B. Kaizen, the official story is that they actually did a little bit better than they thought they would. He calls it a win given the dynamic operating environment, which, is just corporate speak for things are pretty tough out there.
But as always, the numbers tell a much more interesting story. And what's really fascinating here is the difference between those top two lines. So reported net sales were up 1%. That seems okay, right? But then you look at organic net sales, that's the number that strips out new acquisitions like Roz, and that was actually down 3%. So what does that tell us? It tells us the new brands are propping everything up, while the core original business is actually shrinking.
And to really get what's going on, you have to split the company in two. Campbell's is really a tale of two completely different businesses living under the same roof.
On one side, you've got the meals and beverages division. Think soups, sauces, broths. This is where Rao's lives. And on the other side, you've got the snacks division, which is home to all those famous brands like Goldfish, Pepperidge Farm, and Snyder's Pretzels.
This chart right here, it just lays it all out, plain and simple. In the fourth quarter, what consumers spent on meals and beverages went up 1%. But for snacks, it fell 2%. It doesn't get much clearer. One side of the business is growing, and the other is really struggling.
Okay, so let's focus on the good news first. What in the world is driving all the strength in that meals and beverages division?
Well, it turns out a major consumer trend is playing right into their hands. We're all still cooking at home a lot, and we're reaching for the exact things in this division. Soups for a quick lunch, broths for a new recipe, and sauces for a family dinner.
And the undisputed star of this whole show is Rao's. Buying Silva's Brands, the company that owns Rao's, is looking more and more like a really smart move. It's tapping directly into that desire for high-quality, at-home cooking.
Just look at this number, 8%. In the fourth quarter, Rao's saw an 8% jump in dollar consumption. That is some seriously strong growth, and it shows you exactly why Campbell's paid top dollar for this brand. It is their new growth engine, no question.
All right, so now we got to talk about the other side of the story, the snack aisle, where things are not looking nearly as tasty.
Yeah, the numbers here are not pretty. Organic sales are down 2%. Consumer spending is also down 2%. But look at that middle line. Volume and mix is down a steep 5%. That's the real kicker. It just means people are literally buying fewer of their snacks.
But hey, it's not all doom and gloom in the snack aisle. The company is pointing to what they're calling green shoots. Those little early signs that maybe, just maybe, things are starting to turn around.
And they've got some real examples to back this up. 5 of their 8 main brands are starting to gain back market share. And get this, a new white chocolate Milano cookie drove a massive 27% spike in consumption for the brand. It just goes to show the right new idea can still get people really excited.
So what's the plan? How are they going to build on the good stuff and fix the not-so-good stuff? What's the game plan here? Well, their comeback plan is basically a 4-pronged attack. First, double down on what's working, that whole at-home cooking wave. Second, try to breathe a new life into the snack brands with fresh marketing and new products. Third, they need to brace for tariffs, and we'll get to that in a second. And fourth, they're going to cut costs to pay for all of it.
And they're not messing around with that cost-cutting part. They've just jacked up their savings target by 50%, from $250 million to $375 million by fiscal 2028. That is a huge jump, and it tells you they're serious about finding the cash to fuel this turnaround.
All right, now let's talk about that third point in their strategy, because it's probably the biggest challenge on the horizon. We're talking about a massive external storm that is completely changing their outlook for next year.
So you might be wondering, what exactly is this tariff storm they're talking about, and why does it matter so much to a company that just makes soup and snacks?
Well, in the simplest terms, tariffs are just taxes on imported goods. And for Campbell's, this hits them right where it hurts. I mean, think about their most famous product, soup in a can. The steel and aluminum they need to make those cans are now subject to tariffs, and that makes them way more expensive.
And if you want to see just how big of a deal this is, look no further than this chart. The company is projecting that a full 2/3 of their expected drop in earnings next year will come from tariffs alone. That is a massive headwind that no amount of fancy new cookies can easily fix.
So here's where we land. Campbell's is betting it all on comfort food and premium sauces, paid for it by some serious belt-tightening, all to get through a major financial storm. The strategy seems clear, but the challenges are huge. So the big question is, can this 155-year-old giant really innovate its way back to growth across the whole company? The next year is definitely going to be telling.